Good afternoon and a very warm welcome to the distinguished panel chaired by CA Amarjeet Chopra ji, past president ICI, who had been an icon in the profession and has been representing the institute at national and global forums. We also have with us CA Prak Kulkarni, who is a registered valuer and a good friend of ICI RBO, has been contributing a lot to the profession. Now, today's engagement for next 2 hours is on startup valuation issues and challenges. Now, it's a very dynamic subject because we have entered into the phase of innovative disruptions, and the new age businesses, they have shifted the rather radically shifted the transition of brick and mortar economy to a collaborative economy. And the uniqueness lies in the use of internet, digital technologies, increased penetration of internet, and the mobile penetration. What is important is, unlike the usual brick and mortar economy, the transaction takes place on real-time basis through power of clicks, and they virtually operate on a multi-sided platform. Now, this demand economy is no longer a millennial preference. Rather, as I said, the increased penetration of digital technologies has enabled this. And we have a lot of startups coming up in the sectors of B2C, business to consumer, and e-commerce, agri-tech, fintech. They have seen a large emergence of these startups. Now, what has challenged the dynamics is these startups are collaborative and inclusive. And the importance is that uh, as the millennial generation demands, the excess over ownership, like nobody needs to hire rather buy a taxi, but use a taxi, the Uber Ola app, and that kind of transition has taken place. Now, the increase in what do you call job creation, we have about 1.5 million jobs annually being created through startups, and 1,400 global startups. And out of every 10, one is in India. So rightly, we are being called up as the startup capital of world. But is that so well? And is the green shoots which we are seeing are the fast forward to reality? Is it the same or is it different? Now, as any business would have it, there are continuous challenges and responses. There are newer risks, newer sources of risk, and while these startups cross the entry barrier, but usual risks of credit, market, liquidity, operational risk, they are all there. Now, as we have recently seen, the sheen of the startups is virtually fading away, and most probably it is seeing that it has become a victim of its own success. Now, if we go by the latest reports, they point out that the fall in funding in the current year was 70% as compared to 2021 and 2022. And the NASSCOM report in relation to the tech startup says that the unrealized IRR that is declining, and the startups are demonstrating difficulties in maintaining their valuations. And similarly, the NASSCOM report further says that in the follow-on rounds, there is a drop of nearly 40% when they are going for subsequent funding. In terms of the listing of IPOs, the numbers has gone down drastically. We had 53 plus tech, 10 in non-tech and tech sectors in 2021, which has drastically fallen in 2022. Now, these startup businesses are idea businesses, and these are young companies who have short histories and dependent upon private capital. And many of the standard techniques which we use to estimate the cash flows, growth rates, or the discount rates, they yield the very unrealistic numbers here. So the traditional concept that the valuation would be derived from quality of revenue, moat, market share, team, CAGR, that becomes slightly complex here. So I think we have a challenging debate ahead, because some of the startups like the WeWork debacle in 2019, $47 billion company in US going to trash in just few days when it was going for an IPO. So this kind of bubble burst, is it sustainable? Are the valuations sustainable? So I think we have a very learned panel, and this subject is important because ultimately the collateral damages to the real people and the real community. With this, I once again welcome the learned panel, and I request the Honorable Past President C. Amarjit Chopra ji to give his address. Thank you.
Thank you, Rakesh ji, for setting. I think the objective is very clear, and of course, Mr. Parag Kulkarni is there, who is going to take up the real topic. I am only to deliver some kind of a keynote address or inaugural address, whatever name you can give it to, for about 15, 20, 25 minutes. You see, it's something which India has seen in the recent past is a spurt in the startups. And as you said, that probably India is emerging as a hub of the startups. There is absolutely no doubt. It has rather emerged already. There are more than 112,000 startups which are registered with the DPIIT. And out of that, there are more than 109 unicorns also. Now, when I talk of the unicorn, it means that you have virtually revenue generation or a total size of more than $3 billion. Now, this is very significant if you really ask me from the Indian perspective. And you talked of the employment generation, and you said 1.5 million jobs are to be created every year out of these startups. But the unfortunate part of these startups is that somewhere or the other, the research says that about 90% of the startups die out their own death. Now, that's a very large percentage of any startup dying out. So accordingly, whatever is the kind of venture funding, whether you call it by the name of the seed capital or something else, it will start dropping down. And there's absolutely no doubt that the capital available with the startups, particularly when you go to the second round, third round now, is not available in those volumes as it used to be earlier available. You see, when you get into the valuation of any business entity, what do you see ultimately? Because that will answer why it is all happening. One is that you have to have a history of the business, you have to have an historic trend, but then the name itself very clearly suggests that it is a startup. When I talk of the startup, it clearly means that it's a new technology, it's a new business model, it's an uncharted path somewhere which a particular entrepreneur has actually undertaken. Now, that entrepreneur can be belonging to a technology side, or it can be from the commerce side, it can be from any side. It can be from rural area, it can be from the urban area. It is only a conceptualization of an idea, and if it can be commercialized, basically, and if it is commercially viable, if it is technically viable, if it is financially viable, in that case, it can be termed as a startup for that particular matter. Now, the point that one has to understand is that somewhere or the other, because it is actually generation of an idea, and in India, I think there is no dearth of the ideas to be created. I think, of course, this is world over, the phenomenon that the ideas are there. But in the recent past, the kind of ideas which have been generated by the various people, and if I think Prag and Rakesh, both of you must have seen Shark Tank's program on the TV, the kind of ideas that the people have come up with, this is absolutely fantastic. There is no doubt about it. And even when you watch those programs, I think the desire of the various venture capitalists, the people who want to fund those particular projects, what are the deficiencies in that? Or what are the shortcomings in their working? Or what are the strong points in those businesses? Those can be very clearly seen in those programs. and on what basis these people actually fund those projects. That's very, very important to be seen. Now, one thing is very clear, that there has to be a new idea, there has to be a new business model, there has to be a new technology. And if there is a new technology which is actually not merely an idea, but which is commercially viable, which is financially viable, which is technological viable, people are willing to fund it provided there are consumers. And if there are consumers, it will definitely be financially viable. If there are no consumers, it cannot be viable under any circumstances. No, any technology has, if at all, has to succeed, it has to have some kind of a consumption at a particular level. Now, in India, one thing is very clear. Why India is growing? India is growing because there is a lot of internal demand for that matter. And why various people are willing to invest in India? Because of the domestic consumption. Now, when you talk of these startups, there is no historical data because it's a startup. There is absolutely no historical data. There is no revenue generation, probably. Or if a particular project or if an idea conceptualization is only 3 years old and people have gone ahead with it, probably it could be 1 year or 2 years or 3 years. The revenue generation could have been very less, or could have been not there, or could have been into the losses also. But the beauty of a startup is that the people who want to fund it may fund it even if there are losses. I think that's very important. Provided the people who want to fund it know it, that today there are losses because in the short run, you are not able to generate that kind of a revenue, but over a period of long term, you will be able to make it a success so far as this particular project is concerned. So they are willing to fund you. So if a startup is in losses to begin with, it does not mean that there will be no takers for that particular startup. And there could be people who will be willing to fund that kind of a technology also, will be willing to fund that particular business model also in those circumstances. And the second thing is, I think recently we have seen Rakesh ji gave example of the taxis, basically whether you need to own the cars or you can hire a taxi, or whether even in the taxi business you want to own a particular taxi or you want to do it the other way around, you can become an aggregator, you can have a particular platform. I think you look at Ola, you look at Uber, you look at something else, you look at Oya for that particular matter, even in the case of the hotel business. I think all these aggregator businesses come in. You look at Zomato, you look at Swiggy, the kind of businesses which have come in, and this is virtually the brand creation. And if you are able to create a brand, if you are able to create the consumer, if you are able to create some kind of a revenue out of it, there are people who are willing to fund you. And then some of the startups have been sold out at absolutely astronomical valuations under the circumstances. But then there are certain, you can say, startups which did very well or were shown to have done very well. But when it came to the exit route, the prices have come down. The listing was done at a particular price, but then drastically those prices have come down. I think Paytm is a classical example of that. Now, what are the challenges so far as this particular valuations are concerned? I think that's the topic of the day, and Prague, of course, will be taking up that particular issue. To me, I think I've already talked of the historical parts. To me, the basic challenge for any person who is willing to fund a particular startup is that what kind of assumptions have been made by the people who have gone into the startups. What kind of assumptions have been made? And I personally feel that there is a conflict of interest. The person who wants to raise the funds will like to show that it is the best possible business in the world. And the person who wants to fund it will say that probably it is not as good as it is made out to be. He will try to give more of negative factors, whereas the person who wants to raise the funds will give all the positive factors so far as the business is concerned. So this challenge will always remain. So you have to look at the assumptions, you have to look at the aggressive accounting policies which a particular startup might have assumed There are startups where the advances even might have been treated as income under certain circumstances. I think this is one challenge which always crops up, and that one will have to take care of under all circumstances. Then there can be a lot of hidden costs so far as the forecasting is concerned. One of the major challenge for any startup is, of course, one is the idea conceptualization. The second is getting the technology tested, whether it is actually technologically feasible. Thirdly, being able to raise the resources, and you will be able to raise the resources only if it is feasible, commercially also if it is feasible. And for that, you have a lot of marketing to be done. For any startup today, one of the main factors which comes in is what kind of marketing cost will have to be incurred. I think when one used to look at the program which I was talking about, Shark Tanks, etc., one question which was always asked about is what is the total number of not only the sales, what is the total number of the repeat orders that you are getting? Which means what is your consumer base? And if that consumer base does not come back to you, and every time you have to create a new customer, probably that's not the right kind of situation to be in. So how you are able to market your product, and if the marketing costs are going to be very high, probably that could be one of the factors which will have to be factored in when the valuations come in, when the valuation is to be done in respect of that particular project. Then one other very important aspect which comes into my mind is with regard to in any fundraising today for the startups, there are different kinds of capital which are coming. There are different kind of funds which are coming in. One is that it could be by way of the absolute CCDs, or it could be by CCPs, or it could be by equity capital, wherein there are differential voting rights. There are differential rights attached to equity shareholders. So when you value a particular startup, I think Pragji will be able to tell later on. In all those cases, there will be 2-3 things which will have to be factored in. Number one, to my mind, will be if it is a CCD, if it's convertible debentures, cumulative convertible debentures for that matter, in that case, to what extent there will be dilution of the capital at the end of the day. Similarly for the CCPs, and similarly with the equity. Now, equity with the differential voting rights can have its own implications. If you are able to give certain preferential rights to the people concerned who are funding the project, probably your valuation could be higher. They may be able to give you more funds compared to when you are not willing to give them the more rights. People will always start with that, probably they want 50 crores, 30 crores, 20 crores, whatever value. And ultimately, the person who is going to provide you the fund may say that I am only willing to give you 5 crores. We have seen in the programs that the people who came with the startups, they will start with a particular amount, but later on, they will give some kind of a rights to the Shark Tanks, and then they will agree to a particular amount which could be much lower than the amount that they had come up with. Why? Because they knew to begin with that probably when they are not giving certain rights to the Shark Tanks, in that case, probably they will have to agree to a lower valuation, and in that case, lower funds will be coming to their kitty in those circumstances. In any valuation, the most important aspect will be the growth prospects. What is going to be the growth prospect for a particular business? If the growth is steady, but it is sure, probably you will be able to get more valuations. And if it is going to grow over a period of a long term, and you are able to reach some kind of a stage where it can be converted into a unicorn also, or it can become cheetah or gazelle, as the unicorn words say. Basically, in that case, the valuations could be absolutely different. But if you remain much below cheetah or gazelle, in that case, the valuations could be different under those circumstances. Another thing is that what kind of a market share you can have. Now, if you are able to get a good market share, and I think it is difficult to define. This is one of the challenges in the valuation of the startups. What kind of a market share you are able to capture? Now, there could be, you take the case of the electric vehicles. Somebody must have come up with a particular idea at a particular point of time. Now, I think Gadkari Saab is talking of something else, basically. Now, if you start with that particular idea also, then what happens? Now, the sugar companies' share rates might go up. But why these will be going up? Because of that particular idea, which Gadkari Saab is giving you, from which you will be able to generate the energy. Now, if that is an idea which can be exploited technically and financially and commercially, in that case, you will be able to attract good valuations as a consequence thereof. If you are able to prove that probably tomorrow electric vehicles or the other vehicles which are green energy vehicles are able to replace today's vehicles, and the growth prospects are good, probably you might be able to have a much higher valuation for your startup in those cases. So what one is trying to say is that you will have a new technology, you will have a new business model, you will have everything. But most important is what are your growth prospects, and growth prospects in terms of the market share also. If your market share is not going to improve, I don't think that you are going to get good valuations under those circumstances. And then, of course, one of the challenges is that whether there are business cycles, whether the kind of technology that you are adopting may become outdated after 3 years or after 5 years or after 7 years. I think that's going to be a very, very important factor. If your technology is going to undergo a change very soon, probably you may not get the kind of valuation which you might be expecting today. That's one of the challenges when the valuation for the startup actually comes in. And of course, then there are government policies. Now, today, every government is talking of green energy. Every government is talking of ESG, basically, for that particular matter. Now, all those things will have to be considered. And if you expect that certain you have developed a particular idea which may attract a negative opinion of the government policy tomorrow, you may not get the valuation in those cases. But if you have developed something which is import substitution, probably you developed a particular defense product which resulted into import substitution, probably you will be able to get the best of the valuations in those cases. So that's another very important factor which will come into play. Then another challenge which comes into the valuation of the startups is what is your dependence upon your key managerial personnel. That if you have got only one person who has got the control over everything, who has the knowledge about that particular technology, and if he exits the route, then what happens in those cases? I think the valuations may not be as high as you may be thinking. But if there are 2, 3, 4 people in the same startup, and the dependence upon one person is not to that particular extent, in that case, you will be able to get a higher valuation in those cases. And then the experience of the promoters, the experience of the people, of the entrepreneurs who have got into these startups, I think that will be very important. To me, the most important factors will be what kind of patents you have been able to get registered. And if at all you are able to get certain patents registered in the name of the startup, I think you will get a very good valuation in those cases. That's important because patent has got a value to it. The company may or may not have a value, but if you have got a product which is patented and in which probably the other person may not be able to compete with you in those cases, probably you will be able to get a much, much higher valuation in those cases. And of course, today's business is one thing. Another challenge is that you don't have the tangibles with you. I think Prague again will be talking about it. Major valuation hurdle is that you have an idea and you are selling that idea. And even in selling that idea, you don't generate brick and mortar. I think this is what Rakeshji talked of. You create something which is absolutely intangible. And when you are generating something intangible, it is more in the nature of the goodwill. It could be in the nature of the brand, it could be in the nature of a patent. Now, if that intangible, whether banks will be willing to accept that intangible as a security, whether the people who want to fund you will be willing to accept that as a security, I think that's one of the very, very important factors. I still remember when Kingfisher, I'm not talking of Kingfisher as a startup for that matter, when Kingfisher brand was given to the banks accepted it as a security. But what happens to that brand today? So far as the airline brand is concerned, I'm not talking of the Kingfisher brand as a distillery for that matter. So I think intangibles, whether it is a software or anything, that's a major challenge so far as the fundraising is concerned. And of course, integrity of the promoter. Getting into the integrity, if the integrity of the promoter is strong, if it is, people can say that we vouch for his integrity, we vouch for his sincerity. He has never defaulted anywhere in his commitments. I think you will be able to get a much higher valuation in those cases. And then the capacity, the perseverance of the promoter, the sincerity of the promoter to continue, the sincerity of the venturer to continue in the longer run, irrespective of the losses which one may be able to incur. If you are thinking of only short run, that I will be able to make quick buck out of it in the next 6 months or 1 year or 2 years, and then we'll get out of it, I don't think you can get that kind of valuation. What is more important is that you should be able to prove to the valuer that I am here and I will persevere with my idea, I will persevere with my technology, I will persevere with my business model in the longer run and will be able to generate the profits out of it. I will be able to generate the revenue out of it. And if you are determined to do that, I think you get higher valuations in those cases. I think more importantly, if you really ask me, as I said to begin with, that marketing is going to be one of the challenges. If you have been able to create the outlets, if you have been able to create a consumer base, if you have been able to create a demand for the product, probably you will be able to get much, much higher valuations in those cases. I don't think that in the present circumstances, you will have to have what you call the DCF method as the valuation method. I don't think that is applicable to the startups. In the startups, the valuations will be applicable depending upon the development stage. If you have only conceived an idea, probably there will be few takers for it. But if you have actually conceived the idea and have something to prove about that particular idea, you may have some more few takers for it. If you have been able to go beyond it, that you have been able to generate some funds out of it, and you have been able to establish that yes, this idea is workable. Technologically, you have been able to prove this particular idea. It becomes still better for the person who wants to fund it. And if you are able to show that there is a consumer base for this particular idea also, which we are able to exploit, you will get much better valuations in those cases. And if you are able to prove that this technology is here for a longer time to stay, this business model is here for a longer time to stay, your valuations could be much, much higher than what you feel otherwise. So what I am trying to say is, of course, the valuation experts are here and valuation experts will definitely like to do their jobs. But in my idea, history is missing. It's only an idea which is there. What kind of idea is there? That will be seen by the fund, people who are going to provide the fund. What kind of rights you are giving them? What kind of customer base you are able to show them? What kind of technology you are able to show them? What kind of commercial viability you are able to show them? That will all determine what kind of valuations you will be able to get in the longer run. Startups, there's no doubt about it. But I think the number of startups which will continue to enjoy the fundraising may not be as high as we think. And if everyone starts thinking that I can have a startup on my own, I don't think that's going to work that way. And Rakeshji talked one thing about 1.5 million jobs to be created every year out of the startups. But Rakeshji, if 90% of the startups are going to die out their own death, then those people will be on roads also. I think that's very important to really look at. So what we have to make sure is that people have the perseverance, people have the determination, people have the sincerity to carry out their projects under all circumstances and make sure that these startups ultimately get into the stages of cheetah, gazelle, and then unicorns. That's where I will like to stop. Thank you very much. Thanks a lot.
Thank you, past president, sir. And you had very beautifully summed up the entire thing. In fact, you talked about the maturity model and the apart from the evaluation of the startups and the multi-dimensional perspective, which is very important, the governance part, the integrity of the management, the continuity of the business. So all these are important. And of course, as you very rightly put it, the startup is here to stay. Only thing is the maturity curve may come up very soon in some companies. Of course, it depends upon the kind of competition, the sincerity of the management, the continuity of the businesses. So all that is important, and we will have these startups going up in public interest, and because there are very high stakes attached to it, other than the funding aspect. So on behalf of the institute, because you will be retiring from this particular seminar
But
soon, so I propose a very hearty vote of
before you propose that, I would only like to say that in all startups there are a lot of governance issues today. Very frankly, people are showing the. I think as like any other business, as in the corporate world, people say that there are independent directors, whether they are really independent or not, whether they are able to stand up to the venturers or not, the entrepreneurs or not, because the kind of salaries which these entrepreneurs draw for themselves at times, I think these must show certain concern. The independent directors must show some concerns to that. Unfortunately, it is not happening. And whenever the fundraising is done, probably some of the people feel that it is our own money now and we can spend the way. The people who contribute to the funds need to exercise much better control over the utilization of the funds. They do it. I'm not saying that they don't do it. But the kind of salaries which are drawn at times, the kind of expenses which are incurred by them, and the kind of aggressive accounting policies which are being followed, which the people who may be providing the funds may not be able to understand at times. I'm not saying that they will not understand, but maybe at times they are not able to understand. I think we really need to look at those and we need to plug those loopholes if the startups have to become a success in the longer run.
Thank you so much for your concluding words, sir, and so delightful and insightful to always hear from you. I think you brought in your entire experience of very different kind of dealing with different kind of industries and integrating that with the startups. Because if I put it, your talk moved like a pendulum from different dimensions and covered each and every aspect of it. Of course, when we move in life, uh, the startup has created rather penetrated and the barrier, the entry barrier, which is required to be important for entering into any market. But sustenance part is like any other brick and mortar business, in the sense that the businesses would go through growing up phase, consolidation phase, and for each there would be a different strategy. The governance aspect, the ethical aspect, and preparing a risk-based framework and getting it embedded with the overall operational strategy of the startup. This is not going to be different from any other usual business. So I think your talk has come at a very right time, and thank you so much for your very insightful comments. Thank you so much.
And thank you very much, Rakesh.
Paragji, as I introduced you in the beginning, you have been a registered valuer, member of the institute, and this subject is very core to your heart. And I would request you to enlighten the audience as to what are the issues, how they are to be addressed, and going forward, what role the registered valuers can play in providing a sustainability framework to the governance mechanism of this startup organizations. Over to you, Paragji.
Thank you so much. Am I audible, sir?
Yes, you are.
So, Honorable Past President Amarjit sir, Dr. Sehgal sir, Sarika ji, ICRB will directly jump onto the subject which we have gathered today. Obviously, valuations play a crucial role in startup ecosystem, and I'm really excited, to share my insights and experience with all participants. And I'm very confident that discussion today that we'll be having will be both imperative, informative, as well as engaging. And I hope that all of you would see a value in this conversation. So once again, thanks ICRB for having me here, and I look forward for this insightful and productive discussion. So valuation ecosystem from the mergers perspective that I cover, and Amarjit sir had rightly identified design startup have it heavily relies on the promoter and on the one hand. Hello, am I audible now? Hello? Yeah, sure.
Your voice is cracking. Voice is cracking, Prag.
Sure. So if the issue persists, please break me in between. Otherwise, I'll continue with the discussion. So like Amarjit sir was.
Before I leave, my best wishes for a very happy new year to everyone. God bless you all.
Thank you so much.
Happy to you, sir, and your family also.
Thank you, sir.
Yeah. So, like Amarjit sir was saying, by design, startup ecosystem pose inherent limitation as it is heavily lopsided dependency on the promoter, the ideation, the founder. On the one hand side, he looks for the fund for product development and market development, but on the same side, we have seen a lot of governance issues, and hence how to find a balance while you look for the development, which could be through the new ideation of product, could be penetration through pricing strategies, could be geographical market expansion, could be diversification, and then expanding those diversified lines into same geography or to multiple geographies. I think these are all relevant questions. So what I'm going to do is I'm going to pose certain questions that typically we have while we evaluate startup, its commercial feasibility, and all in all, how the startup looks in the framework of the startup ecosystem. So very obvious question that we physically, first thing ask is, how much capital do you really need to start this new business in this industry? There are startup costs, equipment costs, marketing costs, and we have seen people often falter in coming up with the right number. They always speak about a valuation. They speak about the anticipated numbers, revenue, etc. But when we ask them within a time frame, have you really identified the total addressable market, total serviceable market, and then serviceable obtainable market? So the concept of TAM, SAM, and SOM is very, very relevant. And then you need to travel from SOM, the obtainable market, to your actual budgeting framework. That how much do you budget? And then in the fund flow statement and cash flow statement, how much funds you really need. The second question that we typically ask is, do existing players benefit from the economies of scale that will make it difficult for newcomers to compete at a cost level? The third question that we ask, which is associated with the brand recognition and customer loyalty, which is primarily on how strong the existing brands and customer loyalty is, making it difficult to the newcomers or new entrants to attract the customers. Merely having new idea is not equal to having a good commercial business. Specifically in the technology side, we have seen somebody comes up and says that, I have built a product. And a very relevant question that he or she must ask, and we as a valuer must ask, is it a product or is it only a feature that has been built? And if it is only a one feature, it is so easy to be replicated. And now with the advent of AI, in the word of the ChatGPT and Bard, I know for a fact that people who assume a feature equivalent to be a product have been faltered. Now they were not able to achieve what they initially promised to their investors. The next question could be on a regulatory hurdle. We must ask, are there significant licenses, permits, or regulations that are necessary to navigate the new business? Because obviously that becomes one of the threat to the new entrant. Other aspects on B2C or let's say D2 side are distribution channels. Are existing players well established, whether to have the well established distribution network and channel, which is going to make it very, very difficult for you as a startup to reach out to customer? Do you have the deep pockets? Exactly which consumer segment are you heading to? These questions are so relevant before even we take up the valuation engagement, before we even start with the number crunching. Because until and unless we really understand that a founder, a promoter, and its board of advisor have strategic clarity, has absolute clarity in terms of how they are going to navigate and where the funds will be finally utilized. Who are major players in the industry? What are their strengths and weaknesses? Have you done the Porter's 5 forces analysis? Have you looked at the competing landscape? If not, that becomes the first step. How fragmented is this industry? Are there opportunities for new entrants which can be carved out on the niche market? And if it's very niche, what is the possibility of scaling up? Whether the higher margins that you are anticipating, is it coming out of the niche industry, or is it really because of the product differentiation that you're doing? What is the historic track record of anybody who is joining this industry? Because like you are ideating and you wish to participate in this industry, there are thousands like you who are now graduating from Ivy League, who are graduating from IITs and IIMs of the world. And we wish that young blood and young mindset aspires to begin with similar kind of business. So the real question that our client and to whom we are assessing must answer is, these are all other questions. And this particular due diligence of the client with starting up becomes important. When you ask this relevant question, you will realize that a person wants to start up for a fact that either he comes from a family where everyone is a business oriented person and now he wishes he has to do his independent business, or somebody comes with a good education background, he has been doing extremely well in education but now has to do his business, or third, which is a disguised entrepreneurship where people apply to different companies, unfortunately end up getting employment which is not really attractive, or maybe doesn't end up getting employment and they want to start their own company. Or sometimes people believe that something is really big but which is something like just a feature, and then they wish to start up. So startup is not equivalent to you graduating from a college or school and then starting your own business. Startup is a serious issue. It's a serious business. We call something as a startup because we want to give a new age name, but it's as good as creating something which is unique. When the first generation entrepreneur has built something and with second generation entrepreneur joins him, for him also exploring the new market, new geography with the existing product is as good as the startup, because this is an unexplored territory. A segment and test would be different. Now let's shift our focus buyer side. So how many buyers are there for your product or service? Are there a few buyers, or let's say larger buyers or smaller buyers? What is the size and bargaining power of, let's say, the largest buyer? Are you in the volume business, or you are in the differentiation business? Do any of the buyers have significant switching power and capabilities? And can they easily find alternative solutions? Because if they can do so, then you are a mere substitute. What is your total sales pipeline? And then whether your TAM, SAM, so optimal market, budget, it's something where you are heavily reliant on one of the customer. Then, I don't want to give too much value to you, because these becomes one of the key ingredients while I then do the number crunching around the discount rate and the cash flows of multiple or EBITDA multiple. How differentiated is your product or services from the competition? Is it unique or replaceable? Like, I'll quote an example. Somebody came to us and say that we want to do valuation of the content. Content, let's say, imagine a content which is financial content or scientific content, technological content, or let's say any commercial content. And very obvious question that we had was how easy it would be for artificial intelligence, specifically generative AI, to replicate the content that you have written. How easy it would be for you to write a book with the help of generative AI. The time is no long when tomorrow the dialogues of the screenplay are written by generative AI. The only prompt that is necessary that we need to give a tone, and the tonality and the language and different features and characters. If you feed in well, you will get the right output. So typically, when we do the intangible asset valuation, which is a core of startup valuation in that sense, of the startups which are heavily dependent on, let's say, some of the contents or some of the technology, the real question is, what is obsolescence of what they have created? Or in terms of the replacement cost or reproduction cost, can it be easily reproduced and replicated by the newest technologies? And if so, the historical approach of looking at the time and effort basically slashes out. It is something that cannot be applied in the new world while you do the valuation, because something that can be easily built up and created at a very quick pace with the help of generative AI. Let's look at the substitute threat. Are there any readily available substitutes for these products or services? What is a core? Because let's look at the financial market. If somebody claims that the content that particular financial module has occupies, or let's say particular financial content, it's something which is very unique. Now, the value is attributable to the product only because of the uniqueness. Otherwise, in terms of the content, what is profit remains a profit. The explanation of revenue growth remains the explanation of the revenue growth in all kinds of books. Or if I have to speak on a technology side, if somebody has built in, let's say, a chat. Now, whether you chat it on the basis of NLP, which is a natural language processing, part 1 or part 2, ultimately it will be processed. So the real question is how differently you are adopting to the NLPs and ML, machine languages, and then bringing good customer experience and consumer experience on the board. This is something that is going to bring true value. In terms of the competitor rivalry, what expected future growth or prospect of the overall industry? How will this industry grow and will impact the competitive landscape? In terms of the market share, how the market share is distributed among existing players, and whether you're looking at the overall market expanding and then you're acquiring the new market share, or is it more of the Red Sea kind of strategy where it's full matured market and you need to buy out customers or consumers from somebody. For example, if somebody says that I want to open a hotel, and he says that no, it's my startup, we are going to offer unique Italian dishes, or let's say unique Indian cuisine, or unique experience. The real question is, the consumers are one and the same. People will not go for all 7 days of a week to go out and eat in the hotel, right, in the restaurant. So people would tend to go out and have celebrate during maybe the last quarter of the calendar, and mostly on some of the other unique dates which are festival dates. Hence, you're looking at the strategy where the consumers are limited, the days on which the celebrations would happen are also limited, and then there are other restaurants in the same territory. So how and which kind of unique experience are you giving? Because that's still a startup. So I think looking at the competitive landscape, looking at the customer loyalty, And that's the reason, we have those batches and points, which can be then earned out by customers, and then you ensure that they are loyal to you. So these are all relevant questions that must be asked even before all of us taking the valuation engagement. Only asking these questions and answer to these questions in true. So what we are going to do now, we have, let's say, approximately an hour, and I'm going to maybe take you through some of the real life studies. So just a second, let's share my screen. I hope my screen is visible, and I'm going to cover today something on introductions and the players in the startup ecosystem, decision to buy and sell, pricing of the Fangam stocks. Fangam stocks means FANGAM, that is Facebook, Amazon, Netflix, Google, then Alphabet, and Microsoft. Sorry, Amazon and Microsoft. Okay. Then we are going to finally look at find the value, and then last but not the least, how to unlock. Lies, it's a composted value which is there in the cash flow, but then how you truly unlock it, that's the real thing. And will you unlock it, all depends on the promoter and the strategic advisory that comes in a way. So let's move ahead. There are typical headwinds and tailwinds in the journey of startup, and I've segregated it into two parts. One is the layer, which is a macroeconomic layer, and another is a microeconomic layer. As of today's date, the interest rates are too high. I mean, once upon a time, I remember when we did the macroeconomic analysis. By the way, we recently completed one of the research, and which was also published in ICI's journal. I strongly recommend, if you get chance to, you go back and look at ICI issue in the month of October, I think, October, where we have published this research. You would see that. So if you look at, let's say, 5 key economies: USA, Germany, Japan, China, and India, you would see interest rates have gone up since the COVID time. And the interest rates in different maturity bonds, for example, 10-year bond, 5-year bond, 1-year bond, 3-month, 2-month, and 1-month bonds, have dramatically reduced as a response in monetary policy by federal banks. And it was quite obvious this is how the monetary policy works. Each time there is a liquidity issue, each time the business is not growing, each time there is a supply chain disruption. What happened in the COVID, there was a monetary shock. People were facing, there was pressure on the cost side, because even if you have to retrench people, you have to pay them 1 month salary, and it's a huge loss, right? To pay them 1 month salary, or to retain them, but you don't have a visibility around the revenue side. So each time such uncertain situation happens, typically as a part of monetary policy, the federal banks are going to reduce the interest rates. So for all maturities, for 10 years, 30 years, 10 years, 5 years, 3 months, 2 months, 1 month, the bond market immediately slash the interest rates. Lower the interest rates, obviously inversely proportional to the valuation. Logically, the valuation should have gone up. But there was a true impairment on the cash flow side. So this was a unique situation where the cash flows were impaired, the discount rates were reduced. However, there was reduction in the valuation. So lower interest rate is a tailwind. Obviously, it must support for a better valuation. But you would see that the dramatic reduction in the interest rate was primarily attributable to a supporting mechanism of the federal banks or a monetary policy. Now, in doing so, the demand push inflation happened. Higher the cash in the economy, when banks push the cash inside the economy, a lot of startups, specifically in the USA, received direct help in terms of money. It's a monetary help that startups received. Government said that you continue to employ these people, and we are going to give you subsidy. We are going to bail you out. So even if you search today, there's a COVID funding that happened in the USA. Similar COVID funding happened in different parts of the world. Not similar funding happened in India. Now in Indian market, the funding did not happen directly through the government. like the money which has been paid in the pockets of startup. But Indian government definitely supported the manufacturing setup through the banks. They created a lot of non-interest paying debt debt scenarios, and that's how they supported. So looking at the interest rates, its translation into CPI, which is a consumer price index that in turn we utilize to measure the inflation. Looking at the geographical maybe the conversation in between the economies that gets reflected through the exchange rate, the economic growth, like in case of India, it's good. We are quite insulated from the shocks that Europe faced and that USA faced in last couple of years. We continue to, I mean, we means India continue to record GDP growth rate of more than 6%, and which is in itself is good. We recently crossed the total GDP of 4 trillion US 4 trillion, which itself is a good benchmark, but it may not be sufficient in terms of the nation building, capacity building, and capability exploitation. Last but not the least, one has to also look at the credit crisis. A time comes, like it happened in case of 2007, when the interest rate reversal happens. And I think we are marching somewhere towards it. So there was a reduction in the interest rates. The stock market went up. Because stock market went up, we had better revenue multiples, better EBITDA multiples. At that point in time, all startups valued at a significantly higher value. And in the real life scenario, I'm going to present to you how Fangam stocks were valued during those times, during COVID time and post-COVID time. So obviously, the interest rates were low, and after some visibility and some certainty was visible somewhere around May and May 2020 or June 2020 or thereafter, obviously valuations went up significantly. Now, which are the headwinds and which are the tailwinds? That's the discussion. So on the macroeconomic side, these are the headwinds, which sometimes can also be tailwinds. As the interest rate reversal happens, obviously it would be a tailwind. It would be headwind because now the interest rates will start going up, and it will definitely have negative repercussions onto startups. Specifically, current year, that is calendar year 2023, we have seen the least deal making activity. We have seen down rounds. For example, if the deal happened, let's say at 50 million USD valuation in year 2022, now we are seeing the valuation of 35 million, 25 million. Why? These are the down rounds, which are also, triggering the warrant related other obligations that were signed by promoters and funders. So gauging macroeconomic headwinds and microeconomic headwinds are very, very important. Macroeconomic headwinds are primarily attributable to local observations. How is the supply chain? How your vendor and customers are behaving. It also is attributable to, let's say, the management, legal issues, liquidity issues, operational issues, efficiency issues. And some of these issues can be addressed with strategic framework, such as maybe Six Sigma principles, just-in-time principles, by deploying good costing techniques. But whether the startups have an ability, intelligence, existence, and learning curve to deploy that or not, is a real question that you and I must ask in order to really validate the possibility for that startup to be a successful. People say that 8 out of 10 startups fail. Now, what are the reasons attributable to those failures? Ideation could be same, but I think the management and the strategic framework is something that is typically missing in those startups which fail. Let's move ahead. So ultimately, it all trickles down to strategic transactions, strategic directions, strategic agreements, and growth strategy when we are looking at a startup with the exit strategy, when we are looking at not only the funding round, but also M&A rounds. For any startup owner, the real question is, okay, you're doing something, you're building something, you're creating something. What is your exit strategy? And according to you, when you intend to exit, or do you wish to exit through IPO? Do you wish to continue in the IPO? Do you wish to exit through Series A, Series B, after Series A, Series B funding? Like ultimately, someone has to realize the cash. Otherwise, we'll keep on doing business, building up something without you realizing it. So that doesn't make any sense. So it could be translated through leverage buyouts, could be through management buyouts, could be sometimes, the larger strategic investors coming on board, and then it is channelizing your asset light models by collaborating with the leasing organizations, looking at the regulatory framework. So, working in a startup or valuing startup, it's possibly one of the most complex things. And like Segal sir was saying, simultaneously, it should not be only measured in terms of the financial performance. One has to also look at the governance side of it. MIS, weekly monitoring, project monitoring, the monthly review. These are all relevant aspects. And often we have seen where the governance issues are present. These are typically the issues where the divergence of funds happens. When the promoters and startup owners receive funds from the VC capital, and then they diversify these funds by way of unethical measures, like collaborating with somebody, manipulating books of accounts, like we are seeing in one of the companies. And I feel no hesitation in taking name of the company, because this is something which was on the public record, and I am re-quoting what was written in the public record. The name of the company is Byju's, and everyone questioned the authenticity of the numbers, specifically on the revenue booking. Now we don't know whether something that they quoted to be a revenue is right or wrong, but it's a classic case of startup, and it's a classic case of the question around the governance and the ESG. That G is related to governance. ESG framework obviously brings credibility to the valuation. If there is an impairment on the G part of it, the valuation that you are quoting with the impaired G would obviously get the lower multiple. Am I right? Now, some of the significant decrease in the valuation of Byju's is attributable to macroeconomic factors. It may also be attributable to some of the wrong acquisitions that it made. But I would say, to a certain extent, it may be attributable to the governance issues that they are facing or they faced once upon a time. Let's move ahead. The players. In the startup ecosystem, who are the players? There are obviously two kinds of players. One is on the buying side, one on the selling side. So let's look at the buying side first. Who are the buyers? So obviously it becomes critically important to understand, the players who are involved and their roles, their motivations, and the way the transactions are managed. So strategic buyer. Usually strategic buyer is that entity which is making purchase that intends to somehow consolidate, link, or integrate the other corporations that it owns. And it primarily looks for the synergy where 1 + 1 is more than 2. And the real challenge in such situation is the challenge of often, like I said, the cultural integration, the software integration, ERP integration, talent integration, dedicated expertise in acquisitions. They have dedicated deal teams like family offices and standardized procedures, documents, and models. And there are some, like first-time buyers, where they lack in terms of the infrastructure, experience, or capabilities. And obviously, it usually very costly affair for them in terms of coming up and evaluating. So that's where the first-time buyers often come up with their set of consultants. And there could be sometimes the financial buyers. Financial buyers mostly come, would say that we are primarily looking eventually, we are eventually looking at a sale to get a substantial gain. But what we will do is we will come up with certain recommendations on improvisation, maybe revitalization, or maybe recapitalization that is necessary. And for sellers, obviously, on the selling side, if you could see, there could be partial sellers, there could be a full seller, there could be eager sellers. Now we are seeing a startup where there are people who will start at the age of, let's say, 45 and 50s, and they're successful. There are certain startups which are really successful, but they face succession planning issue. And now these are eager sellers. And there are some people, like 4 people started together. And out of 4, three of the people want to sell it to the larger organization, and one of them says that no, we must continue to march ahead, grow this business more, and then sell subsequently down within 3 or 4 years. So there are certain unwilling sellers as well. So partial sellers may want to solidify a relationship with partial buyer. Example, manufacturer selling partially to retailer, which is the main channel for the sell. And I can, go on quoting the example. But I think, I just wanted to give you a flavor of the stakeholders and their roles involved. Let's move ahead. In terms of owners and investors, you would see there are angel investors, private equity investors, venture capitalists, LBO firms, public investors, MBO firms, institutional investors, and then there is a supporting agency, which includes board of directors, line management, executive management, and development staff. Now, apart from this, there are additional stakeholders. Who are these other additional stakeholders? Your partners, consultants, advisory staff, regulators, press and media for the brand building, competitors, auditors, investment bankers, lawyers, and finally customers. So I think at this point in time, we have apparently understood what are we dealing with. We are dealing with not only two words, startup. We are dealing with something which is a very serious thing. Just we for a fact now, we on record say that startup is not just another evening game. It's not like having your bat and ball and playing a cricket. It's not about having money and registering your product on an online platform and starting selling. It's not a fun game. It's not your artistic activity. It's a serious business. And a serious business is serious because you need people to lead and take decisions. Key decisions, decisions to buy and decisions to sell. Why large organizations decide to buy some other organizations, and why founders are motivated to sell their organizations. Taking decision is a crucial part. Every other thing can be automated. Whatever can be automated will be automated one day. The real fact is that the startups, like Chopra sir was saying, primarily derives its value from the critical thinking abilities and leadership abilities of an individual. And that individual exists to take decisions. Let's look at motivation for large organizations to buy some of the other small startups. So I believe that there could be 5 motivations. Could be for geographical expansion, could be for brand positioning, could be to enter into new product and technology, to acquire customer base, or maybe to achieve economies of scale. Let's discuss, one by one. First, geographical expansion. Everyone is eyeing on our nation, India. You know why? Because for obvious reasons, the consumption is larger. But let me give you some facts and figures. Do you know how much is the GDP of USA? It's 22 trillion. And forget about USA, it's far away in the West. Let's look at our neighbor. Do you know how much is the GDP of China? It's 19 trillion plus US dollar economy. By the way, we have crossed China in terms of the population. Our economy size is 4 trillion USD. Even if we grow by, let's say, 8% per annum, how much time will it take for us to go from 4 trillion economy to 8 trillion economy? And then from 8 trillion economy to 16 trillion economy? You know mathematics, you all are chartered accountants, you come from the finance background. You do the compounding by 8% on an annual basis. We are far away from even achieving the 20 trillion economy benchmark. But is it achievable? Answer is yes. It is achievable provided you and I have a mindset where we don't question Mr. Narayan Murthy's position of working for 40 hours a week. Because it's all about capacity building and nation building. Everyone is looking forward to buy out the capacities in India. And that's the reason, Tesla also, ventured into India market. And many companies are coming. Geographical expansion. It's always a question of build versus buy. If I have to build everything by acquiring the land, starting a factory, acquiring the talent, obviously I am going to lose my time. I have a capacity ready, built up by a startup, let me go ahead and acquire it. It's okay for me to pay the premium because I know I have a market. I need a talent pool. For a software engineer, let's say for a data scientist, how much salary Indians pay and how much US citizens are paying or US startups are paying? Even if we look at the fresher, the internship in the software technology, let's say in the .NET language or Python language, begins at not more than 15,000 per month in India. Maximum 20,000 per month. On the other hand side, in the USA, the internship begins at an annual package of not less than 60,000 USD. Even the PhD researchers, they get, 60,000 USD for their research and for regular, their expenditure. And typical salary of person who completes his masters, let's say not even from Ivy League I'm speaking, somebody who has completed masters from a good university in the USA, and I'm not speaking about MBA, I'm speaking about the MSc in, let's say, computer science, they end up getting a job for anything not less than 1,20,000 USD package, excluding the joining bonus. There is so much of disparity when it comes to the cost of creation in geographical different markets. The cost of creation, cost of building in different markets is different, and hence geographical expansion obviously is one of the motivation. Brand positioning. Sometimes you need to reposition your product through a new brand. We have seen there are brands which are so good but not making good profitability. And there are some other organizations without a brand, but they are financially more healthy. They are healthier. So healthier, less branded organization can acquire a brand and capitalize on it. New product or technology. Pharmaceutical markets often acquire smaller startups with better technologies. Now that may be primarily from the pure science side, or it could be also toward the technology side. Like, let me quote an example. We are working with one of the organization which worked with the Laurel. Laurel acquired one company which had ability to process a photograph of a face. Now, processing the photograph of a face and suggesting how many wrinkles you have and which product should you use, it's something which is a true feature of any startup, right? It's so unique and so innovative. By deploying AI and ML, they replicated the same technology, and today millions of users utilize the technology. Rather, on that basis, the data scientists are working and predicting which Laurel product will they be using and buying down the line 6 months. And we have another client where, the same technology is applied, but now not on the face of human beings, but on the body of the vehicles. The company is into the insurance automation. You click the photograph of the vehicle, you do the video recording of the vehicle, and it will instantly tell you how much damage that vehicle is. And the insurance claim is processed within 5 minutes. You can imagine insurance claims down the line, couple of years or 5 years, will be processed in no time. That's a new product or new technology we are discussing. And there are some other companies where the customer base is present, and you want to buy out for their customer base because for a fact you have certain products, you have certain abilities that can be penetrated by cross-selling to the existing set of customers. And other motivation could be to achieve obviously the economies of scale, where you know that you're buying a competitor. It's a merger of a twin, where you eliminate the redundancies, you kill the competition, and you charge the premium to your customer. Let's look at what a motivation to sell. It's very courageous and difficult to sell because in hindsight, promoters can always believe that I took a wrong decision. I know for a fact somebody who, who had these Dogecoins or Bitcoins, and he used those Bitcoins to buy out one pizza. And then subsequently, when these cryptocurrencies were priced at astronomically high valuation, somebody told me that the amount that he paid to buy one pizza was worth billions of USD. So now that person in hindsight obviously said that I chose a wrong decision to sell those Bitcoins to acquire a pizza. So these possibilities are obvious. Now, what is typical motivation? When you know for a fact that, okay, the interest rates are at its least, and as a student of macroeconomics, I know tomorrow the interest rate reversal will happen. And when the interest rate reversal happens, it's so obvious that it's a natural reversal of the progression. Even if my cash flows remain same, my discount rate will go up and my valuation will go down. So it's the right time, I must sell now. I have created something, I built something, and interest rates up and down is a cyclical movement. They don't come down very quickly. They don't go up very quickly. So I think now we are at a peak of my valuation, my entity's valuation. Tomorrow, even if I improve my cash flow, for which I have to take so much of effort for geographical expansion, R&D efforts, building up new product. Oh my God, no, I'm at a peak. I must sell my startup now. peak of the industry or sector, then among your peers, you know that you have the highest market share, but there is always a possibility of large competition. Third, there is a possibility of new competitor, coming in. And fourthly, that for succession planning, you are actually seeking a liquidity event. Your children are no more interested to go out and continue the same business. And this is a case of so many Indians. For so many successful Indians, their children are, they are pursuing altogether different faculty. Somebody has built up the technology thing, but their children are into marketing, brand building, geographically located at different places. So, the liquidity event is also important. And hence, the startup evaluation must be analyzed from both perspectives. What is the motivation? Because you don't do startup valuation always for the compliance purpose, right? We also do it for the deal making purpose. And the deal making definitely captures something which is beyond normal compliance based valuation, because we try to see the ability of seller to negotiate versus ability to buyer to negotiate. And on the buy side and the sell side, where you stand. Let's move ahead to the real life scenarios, the Fangam stock valuation. And I did not use the word valuation in my slide. I've used the word pricing. Because all these companies, sometimes we believe to be overvalued and sometimes we believe to be undervalued. Let's see how this stock prices were, since the COVID time. So, I've tried capturing since November 18, 2019. The chart that you are seeing on the screen assumes the 0% level at 18 November 2019 as a base number, and then the change in the price has been captured as a part of the percentage. Now you would see somewhere here, can you see this? This is when the COVID happened. And what happened in case of COVID? Suddenly, the investment perspective was so pessimistic that despite the decrease in the interest rates and the cash flows of these digital finance companies remain same, or at least, there was some uncertainty around it, the valuation went down. And trust me, at that point in time, the valuation was not only a dynamic of a cash flow or a discount rate, the market perspective played a crucial role. Your parents, your children, your neighbors, your relatives, your teachers, your friends, everyone was saying, we don't know whether we are going to coexist down there in 5 years. You all are going to die. So negative perception. Sometimes sentiments also get priced and there is no science behind it. It doesn't, so we can't, really justify why this stock has gone down by 30% or 20%. Mathematically, we should, but sometimes there are no takers to the stock. And then it becomes or remains a function of demand and supply, where the stock becomes a commodity. And there is no demand to buy out those stocks, but there is an incremental supply of those stocks. And hence there is a devaluation. But as the visibility started coming in, and as the interest rates are stagnant, they did not reverse at that point in time, the stock went up. And the stock went up like this. Can you see this? All stocks were up until here. At that point in time, the inflations were at peak. The inflations are at peak, and you can go out and change the bond rates. And finally, Federal has to come out and say enough is enough. We have absorbed too much of shock. We have to reverse the interest rates. And they started reversing the interest rates. And when the interest rate reversal happens, it was so obvious the stock prices went down. Now, what were the reasons for all these stocks starting at the same point in time, maybe going together somewhere until this point in time, but then Apple remains a talk bearer and Meta loses the race? What could be the reason? And by the way, these all companies are considered to be companies, that we all look up to. We believe that, like in Harvard, we studied case studies of all these companies under a presumption that they are doing extremely great. So it's easy to speak about Apple as, it goes ahead and march towards surplus cash. And maybe just for a fact check, you can Google what is the cash reserve of Apple and compare the cash surplus of Apple, single company, today's cash reserve of Apple with the GDP of our country, and you tell me which one is higher. Apple started like a startup with the design thinking of Steve Jobs, who himself was thrown out from that startup. Again, I'm reiterating the fact. Chopra sir said, man behind the show is important. The man behind the show in Apple was thrown out once upon a time. He acquired another company, Pixar, which subsequently Disney acquired. And then Apple once again re-invited Steve Jobs. Steve Jobs was a person who did not know how to code. Steve Jobs was a person who did not know many things that today Apple is doing, but still he navigated the organization. Apple continues to offer big breakthroughs. Originally, it offered breakthroughs by the small iPod. Then the second breakthrough came with a touchscreen. The third breakthrough came with a tab. The fourth breakthrough that we all believe is no more a breakthrough. They came with the digital glasses. And they were working in the Meta environment. So there is some correlation between the Apple and Meta here. Meta failed for certain reasons. And that's the case study that we are going to learn today. Meta is the name of the parent company. The name of the organization that we are going to analyze is the Facebook. And let's look at how the Facebook stock went down. It went down obviously from December 21, you can see, until November 22. And when any stock goes down in valuation language, it goes down for two reasons. One is the cash flow. Second is the risk associated with those cash flows. So we are going to now analyze both things independently in detail. Let's first look at the cash flows. Okay. What are the cash flows? So obviously we are going to analyze the revenue, expenditure, capital expenditure, tax that ultimately brings a net income for you. And in my analysis, I'm going to analyze the revenue of this company. Now, this framework that I'm offering you is also a framework for analyzing any startup which you are valuing. Now, for me, the revenue mix that I'm analyzing is in terms of the geography. So I'm saying that, okay, what is the major revenue for a Facebook? For Facebook, the major revenue was the advertising revenue. Rather, it's a key revenue. More than, I'll show you the revenue mix percentage. More than 95% of the revenue comes from the advertising revenue. And in terms of the geography, you would see the US and Canada revenue has dropped from Q4 to Q3. And similarly, the Europe revenue has dropped from Q4 to Q3. So what really happened? That, the advertising revenue was going down. We are coming out after the COVID, and the marketing spend of manufacturing organizations or non-digital companies are now shifted from pure digital marketing to now physical marketing. They started sponsoring different events because world was coming out of COVID, right? And company lacked to showcase a continuous growth. Now this total revenue by the user geography. So this is a advertising revenue versus the revenue by geography. If you would see, for example, in Q4, the total revenue is 15 trillion here. Okay. It's a 15 billion, sorry. This one is 15.82 billion. The total revenue. And in Q4, the advertising revenue is 15.062, which is almost, again, the same number. So more than 98% of the revenue is the advertising revenue. That's what they have. If you look at the segment results, we have, let's say, two segments, which is advertising and other. And if you drill down the Facebook, obviously, because now it owns Instagram and WhatsApp, like you will have different channels. So for any startup, you must look at which channels are bringing what kind of revenue and whether each channel in its context is profitable or not. So there is a family of apps operating income and there is a Reality Labs operating loss. This Reality Labs operating loss is nothing but the metaverse what they are building. And you would see these numbers are getting questioned in the Q1 of 22. You would see this. Family apps revenue is 27 billion and the income is 11 billion. Okay. The income is going down. See, from 32, it has gone down to 27 and from 15, it has gone down to 11. the operating margin has significantly reduced. What could be reason behind it? When you are saying that the margins are reduced, it also means that historically, whatever investment that you're doing on a research side, you are capitalizing. Does it mean that now that development is no more development and your IFRS and Ind AS doesn't allow you to capitalize those investment but must be expensed out, and hence now your overall margins are going down? Because I'm very sure for a fact that you are not doing any separate activity. Like, you don't have a marketing cost for Facebook. There is no market. I mean, there is no significant marketing cost. There is definitely marketing cost, but there's no significant marketing cost. It had a network effect and it went on acquiring consumers through the network effect with mouth to mouth publicity. So don't tell me that the reduction in the margin is attributable to some other cost. I'm very sure that it must be on account of something else. So let's look at deep down into the expense as a percentage of revenue. And I strongly recommend, when you are dealing and analyzing any startup, you please wriggle down the expense on a quarterly or weekly or monthly basis. And you see whether that particular investment, the way they are investing in different expenditure, is it going up or going down? And you would see the research and development expenditure going up, which also means that majority of this R&D expenditure is not qualifying for the capitalization. And hence it was expensing out, which means the research was not proving up to be technologically feasible research. They were trying to do something, but it was not supplemented with a concrete conclusion, and hence auditor must have said that nothing doing, I can't allow you to capitalize it as a development expenditure. You have failed to give me a proof of concept. The technical feasibility is not yet proven. The commercial viability has not been proven. My accounting standard, my US GAAP doesn't allow me to capitalize, and hence you must expense it out. So the key observation is, it was almost 22%, 19% once upon a time, like during the initial quarters. It has went up to 28% and it went on going up to 33% in the last quarter of 22. Now, simultaneously, the capital expenditure has also gone up. So the overall expenditure for Facebook, obviously, we are not acquiring any cars and physical assets. It's all about the metaverse expenditure that we are discussing. So I think the money that was invested in building up the meta was so much so high that, I believe that the stakeholders questioned its ability for the sustainable future, and hence the value of the meta stock went up. Even the effective tax rate went up as the historical losses were absorbed. So the tax rate, effective tax rate, and the tax rated expenditure was also increased over a period of time. Consequent to which, obviously, you would see a sharp decline in the net income. And when the income reduces and when your P multiple remains same, obviously the stock value will go down, right? Now, I'm going to quickly, skip some of these slides, and I'm going to share this, slide deck with ICRB so that, understand. So obviously we will have the entire content which you can read in detail, but let's look at just overall numbers. The overall number, if you would see, this DAP by MAP remains 79%. It's basically the utilization. Okay. So which means that your daily active users divided by monthly active users. So it remains 79%. That's perfectly fine. Daily active people divided by monthly active people, it's 79%, which means, okay, people are still coming on your platform. Now look at the monthly active people. The monthly active people are also growing. Daily active people are also growing. So it's a good sign. People coming on your platform, and if the number is growing, it also means that people are not substituting your platform by going on some other platform. Because at that point in time, if you remember, the Instagram acquisition happened, and because they saved because of the Insta acquisition. The Snapdeal is there, and I think there are parallel, similar to Facebook, there were the risk of substitutes, right? But the indication of incremental users, or at least the DAP, daily active people, growing, as well as the monthly active people growing, is a green light. But then let's look at whether it is really translating in the revenue or not. If the people are growing, I can go out to the organization and say that, please advertise on my platform. And you must advertise on my platform because you are going to find more users on my platform. If this logic is correct, then your revenue per person who is active. Like it's an average revenue per person should at least remain at the same level or it grew. In case of Facebook, it went down. It was highest in Q4 of 21, but then it went down. Why it went down is a real question. That's where the strategic advisory comes into play. And that's where we are also going to ask a question when we do the valuation of companies like this, which are primarily technology driven, that if your revenue per user is going down, what are the reasons behind it? And in my explicit forecast period, when I'm performing your valuation, there's a terminal value and there's a value attributable to explicit forecast period. Whether my assumption is right or is it wrong, or whether any calibration is necessary, whether any adjustment is necessary, right? Okay, let's move ahead. Now, if you look at daily active users, interestingly, daily active users in US and Canada decline. So, though the daily active users and monthly active users on an overall basis has gone up during that point in time, you could see the preferences and tests of people, how they are changing geographically. We are observing from Q3 to Q4 of 21, US people are yes utilizing Facebook. Europe people are yes utilizing Facebook and Instagram and other family apps from Q4 to Q1. Now, all of us are glued to social media. I mean, some of you may not be, and good for you. But if we are not on one social media, then the underlying assumption, we must be on something else, right? We must be on some other social media. So this is an indication that are you losing the user base? And that could be another thing for the devaluation of the Facebook stock. Similarly, monthly active users also reduced significantly in the European region. So quite another interesting fact. Average revenue per user worldwide, it was 9.54. In the US, you would see it was higher, 60.57. It reduced, but it remained somewhere around $50, $49. Obviously, on the Asia side, because of the parity and the exchange rate, the revenue per user was low. But it was not really able to maintain that particular value. As for the rest of the world, it went up, but again, it was rested at 3.21. So this is the real question, because majority of the revenue comes from the US and Canada. So if you're not able to maintain this 60.57 revenue per user, and if you're coming to around $50, then it's a $10 reduction per user. And you can then multiply with the number of billions users that they have, and you would see the serious impact on the overall valuation. Now it's a cash flow reconciliation that we have, but I'll just park this discussion because I will prefer to now discuss more on the risk side. In any analysis of the valuation, like you analyze the cash flows, its revenue ability, the purchasing price, the discount and the margins, etc., it's equally important to analyze the risks. And that risk assessment must be customized to your client. So in a given case, for next 5 minutes, before I conclude my discussion, 5 to 10 minutes, I am going to present to you the risk that I believe to be very specific to a social media platform like Facebook. Okay. And I did detailed analysis. I have segregated my analysis into 4 parts. One is risk related to the product offering. Second, related to business and operational and financial results. Third, related to government regulation and enforcement. And fourth, related to data security and intellectual property. So let's first go and understand risk related to product offerings. What could be potential risk to product offerings? Failing to retain existing users or add new users. Then the users are one and the same, but now the level of engagement is reduced. Like there is an ERP which is built, but if you are selling an ERP, your clients must utilize it heavily so that they are glued to your product. If they now are shifting to other CRM or some other features that are getting from Zoho, then obviously they're no more utilizing this app. Rather, they're heavily relying on the integration that Zoho is offering them, or some other technology platform is offering them, or let's say Tally is offering them. Am I right? So it's not enough to look at the downloads, and it's not enough to see, okay, whether they are looking at your platform. For how long they're engaging with that platform and how meaningful that conversation is between a platform and your user is equally important to test the success of that platform. Yeah, am I audible? Yeah, as you can see, no, it will take 10 seconds for, my generator to begin, and then in this property. Yeah. So now see the generator has begun. So hopefully I will have, the good network. If it is not there, please interrupt me. Okay. So let's go ahead. Third, substantial almost all revenue from the advertisement. You are heavily dependent only one type of revenue. You are not into hardware. Now you intend to go into hardware, maybe by metaverse, or you are experimenting with something else. But what is your revenue? It's purely advertisement. Tomorrow, any bad news come around the secrecy, around the protective rights, and this is what happened. There was a major threat to Facebook when US consulate and the embassy, asked. I mean, the US government asked Facebook to speak on the privacy policies, and there was a moment of time when users believed that whatever we are searching, the Facebook is utilizing that particular content and our privacy is threatened. People were able to get photographs by searching on the Facebook. So somebody you don't know, you just search on Facebook, you get their photographs, you download, and you create fake profiles. So people then became hesitant to come on that particular platform. And if people are hesitant to come on the platform, your user base will go down. And if your user base goes down, your advertisement revenue will go down. So for how long you can run a company which is primarily relying on only advertisement revenue? It's not possible. Look at Google. It's not only advertisement revenue. Look at Amazon. It's not only advertisement revenue. Look at Facebook. It's only advertisement revenue. Make products that may not prioritize short-term monetary results. So that is one of the risks that they invested in Meta. They believe that it's okay to report lower profits, and but we need to ensure more sustainability, and hence they are experimenting towards it. Okay, let's move ahead. Risk related to business operations. When users are going up during the COVID times because everyone has surplus time, and digital companies see outbreak of communication, including Zoom and Google and Facebook. We heavily use these applications, right, to interact with each other when we all were in the lockdown. So because of a momentary scenario, if the user base is going up, then it brings to the volatility of the financial results as well as to the business operations. Because of the incremental usage, you build the capacity by adding hardware and putting up additional servers, and tomorrow this server capacity will go vacant. There could also be a risk related to the delays in product development, and there could, like I said, in the misuse of services. For example, for some unforeseen event like point number 3, if you could read, these are the risks which are real questions. How can you insulate yourself from these threats and risks? Consolidation in the industry that results in formidable competition. Tomorrow, if imagine, like today, we are seeing the chat GPT was created by OpenAI, and suddenly Google comes with its own generative model with the BART. The real question is, for how long the OpenAI will survive with the real competition that is happening from the Google and Amazon, and everyone is coming up with their AI models. Whether everyone will utilize and integrate with the chat GPT, or will people will prefer to write their own ML languages and have their own technology models. Cost effectively growth and manage the operations, that remains a challenge irrespective of the type of startup that you see. For startup, looking at your contribution, looking at your break even is important. People say that investors are investing in loss making companies, but the real question is why there are losses. At a gross profit level, are you profitable? And if at a gross profit level, if you are profitable, then it means the other indirect costs are primarily for your product building and market development, which is okay. And then in that case, it's okay to invest in loss-making companies. Okay. Then the risk related to government regulation, which I'll skip. And now let me go to Apple Inc., which is the other side of the case story. Now this company has in the stock price has increased significantly. It went up significantly. By the way, the entire literature and my analysis will appear on the screen. I'm not going to reiterate the fact. I would wish after you receive, my deck, or maybe when it is hosted, I'm not really sure whether you'll be receiving recording or the deck, but whatever you receive, go through it. I'm going to shift onto my two relevant points which I must cover before I conclude my session. The second last point is finding the value. And we find the value by looking at a segment-wise analysis. Now, this is altogether another case study which I have taken of non-technical company. And this is a non-technical company which has 5 different segments. One, rural and semi-urban wholesale and distribution with franchise network of over 100 stores. Second, end-to-end procuring, processing and supplying in staples categories. Third, processed food, home and personal care segments. Fourth, leading dairy and bakery brand in South India with a franchise network of over 100 stores. And fifth segment, which caters to end-to-end food processing across value chain. Now, the real question is this. First, for rural and semi-urban wholesale and distribution network with franchise network for 100 stores, how will you analyze and review when you perform the valuation? You are expected to focus on review of retail landscape in the specific clusters of North India. Plus, you must focus on, let's say, semi-urban and rural retail sector. And each of these markets behave differently as they represent different features. North India and South India are not only different because they are located one in North and second in South, but they are different in a sense that they come up with different culture, taste, aspirations, consumption pattern, likings, and so many things. How the way retail buyer behaves, whether the impulsive buying happens in North India or South India, they're both different. Buyers behave very differently. And I'm not really biased when I say somebody is better than other, but trust me, they're really different. You need to deal differently for somebody who is coming from Haryana versus somebody coming from Tamil Nadu. Okay, these are the realities. We have to behave differently, and whether startup owner and his marketing policy and whether his product are really appealing to the rural versus the urban market, it's also something that must be evaluated. For end-to-end procuring, processing and supplying in staples categories and for processed food, home and personal care segments, what we must focus on is focus on the business through own retail outlets, other modern trade and general trade. Is it a franchisee model or if it is a asset light model, obviously you will not have your own outlet, or maybe it could be a leasing outlet. Or would you want to enter into a franchisee model where you would say that it's a replica, it's a best practice model that I have, and then you come up with so much of capital, locational advantage and geographical assessment that we will do, and then we will give you a franchisee, and then you go ahead and we will give you the entire supply chain facilitation. General trade and the modern trade, what is the difference between the two? So let me explain that. So general trade is around 90% of the overall retail market and includes the conventional kirana shops. Okay, it's a conventional kirana shop, general stores, convenience stores, and mom and pop stores, or pan bidi shops, and other small retail outlets situated near residential areas. And salon features being smaller square feet area, makeshift shells, cash transactions, owner managed, employing personal capital. On the other hand side, look at the modern trade. Modern trade is around 54% of the urban retail market, and it includes larger format of stores such as supermarkets, mini and hypermarket situations in shopping malls, and handy-picked pockets outside the residential areas. Salient features of modern trade include it's a larger square feet area, proper organized sales, and corporate manager with large capital involved. Now, you can't just say I'm valuing a startup. What is your strategy? What is your consumer segment? What is your geographical segment? Are you hitting the general trade for rural market or general trade for urban market? Or you're looking at the modern trade for rural market versus modern trade for urban market? And on that basis, the revenue mix, the related margins must be analyzed. Or at least strategy and fund application. Like on the funding side, there are sources of funding. On the other hand side, there is the application of funding that must be rightly analyzed. The next is leading dairy and bakery brand in South India with a franchise network over 100 stores. What should we focus on? We must focus on the clusters of South India and focus on the urban clusters and dairy and bakery business. Now, do you know for a fact how this dairy business and delivery business works? There is a manufacturing capability located outside the city limits. Now, there is a huge truck that basically captures, or let's say it has a storage capacity which is a large capacity. It brings that material, let's say a milk and dairy product, until the city limit. And then from city limits inside the city, there are small vehicles which doesn't carry the cold storage facility. They have to distribute milk and other bakery products. And in my observation, the real money that any dairy brand has is not in the distribution of the milk, but in the distribution of paneer or maybe the milk related products. But if you don't sell milk, and if you sell only paneer or only milk related products, you may not be able to capture the market. So the brand value comes because of the customer penetration to milk distribution at a lower margins, but the profitability comes through the allied business margins, allied business products. Fifth, caters to end-to-end food processing across the value chain. So then in that case, we need to focus on, as a valuer, sales pipeline for food park and steady stream of foreign income. Okay. Now this was more on the assessment side. On the last part of my session, which I hopefully will cover in next 5 to 10 minutes, how truly can we unlock the value? And this is my last slide, or rather second last slide. We are saying that in order to unlock the value for that startup, the assessment and framework must be in place for a minimum 6 of these criteria. The first criteria, market review. Second, competition review and brand awareness. Third, the operational model. Then the review of projections. Last, assessment of key business risk and processes. And maybe there could be some other areas. So what we intend to cover in this, what you and I must understand when we say we must focus on this structured thought process. First thing, in terms of market review, you must document what is the market size, TAM, SAM, SOM, your budget, the relevant segments, what are the headwinds and tailwinds, regulatory environment, very important. Second, competition review and brand awareness. We need to establish the right to grow. So first, doing market review means we are only saying we are not yet reached the valuation stage where we are going to apply the discount rate. We are not even analyzing the cash. We are saying, okay, first we are analyzing whether there is a room to grow by analyzing the market. Second is, okay, now if the market has been established, do you have right to grow? Because there is so much of competition. Can you really grow in this competition? That's the second thing, where you are going to analyze the strengths and weaknesses and the intensity of the competition. Who are the players? And even if you do something, will you be sustainable? Because today you may succeed by price penetration. The real question is, when your competition, which comes with the larger capital base, larger consumer base, with the deep pockets, if they tomorrow think to kill you as a startup, what could be a responsive strategy, and can you sustain that? Now, once you have established both things, the market and a right to grow in that market, the third thing, okay, you're right to grow in the market, but do you really have capacity to grow in that market? Do you have the relevant people, skills, talent, the aspirations and the scalability that comes across the value chain? It's not only something that you as one of the person, your vendor on the supply side, on your customer side. Do you really have an ability to grow in that market? So you need to establish the capacity, and then comes finally on that basis the projections. The projections must reflect the market on the revenue side, the capacity on the people cost side, and finally on the profitability side. And there is a possibility that you may end up getting a small pie of the overall market, which is okay because the market may still remain fragmented. But ultimately, as the market consolidation happens, sooner or later, the startup will die its own death. Right? So in that case, assessment of business risk and processes, where you analyze what are hurdles to grow, or will you have a stagnancy in your business? It's so easy on Excel sheet to assume the terminal value with an annuity growth rate of, let's say, 10% per annum. But will you really grow? You can't outgrow if you have geographical restrictions. Like somebody who was in my office before this conference, he was saying that he works offering air conditioning facilities to different large real estate projects. And he said, Parag, we have extremely good margins. We have turnover of 20 crore around. And there are many 20 crore companies. So I'm located in Pune today. Okay. So as of now, he said there are, let's say, additional 10 to 15 companies in Pune who has turnover between 20 to 25 crore. And my turnover is also so much, but we are not going to outgrow. So in order to outgrow, I said, okay, let me develop another market. And despite deploying the best practices and having the talent pool, I failed to apply similar things in the Bangalore and in Delhi. So there are some inherent limitations. So in valuation, sometimes you can't really have the terminal growth rate, which is really significant. As the GDP of the country will grow, but you may not grow. The industry may grow, but the growth is in different geography, you may not grow. Tomorrow, Jammu and Kashmir is growing, but will you grow? Jammu and Kashmir growth, because of the protection and because of the new policies of the government, is adding up to the GDP of the country. That doesn't mean you sitting in your city is growing. Are you going where the growth is? And if the answer is no, then you're not growing. And I don't want to buy at an argument that you will grow. So anyway, I think we had a good conversation around the startup ecosystem. I might have failed to address a very specific issue on the governance, but I feel that there could be separate chapter and separate discussion that we may address on the governance side. Today, I wanted to primarily cover on the critical aspects that are really, really important than merely looking at the in the calculations where we do the number crunching. So I thought to cover up the content, which is little different than the typical content that we otherwise cover. I hope I was able to give you the best from my side. With this, I'll take a pause of my conversation. I don't know whether we have any Q&A here. Otherwise, I'll leave it to now final words of Sehgal sir or somebody from ICIRV.
Well, thank you, Paragji, for a very illustrative and very comprehensive presentation. And in fact, you talked about the importance of analysis of headwinds and tailwinds. You also talked about the market perspective in times of crisis, how the sentiments get priced in, role of management. You talked about the various kind of risks, and of course, unlocking value. So I think overall snapshot was very much there in the presentation. And I'm sure that whosoever attended must have had a very comprehensive grasp of what you were trying to convey. And at least it gave us some kind of a snapshot or some kind of a toolkit as to what all one should be looking at if one is valuing these kind of businesses. Of course, you also talked about the impossibility or rather improbability of factoring in the terminal value, which is very important. Uh, I think from my side, I may not have any questions because your presentation itself gave lots of clues. And of course, there are some open ended questions as one does more deep diving. Possibly there will be some more questions, but definitely the members can always write to us if there are some gray areas which the presenter you feel has not touched upon. From the side of ICIRO, on my personal behalf, a big thank you to you for giving such a nice presentation non-stop for about 90 minutes. And you covered many aspects which went beyond the valuation. And in fact, you covered the marketing aspect, you covered the legal and regulatory framework. I think the multidisciplinary approach which one needs to adopt in these kind of situations was very much there. So thank you. And I think personally, I gained a lot from your this excellent disposition, and so would have the members present. A big thank you to you. And I think in future we'll catch up for such learned conversation more often. Thank you so much.
Sure, sir. Thank you so much. Thank you, everyone.
Thank you.